Okay, good afternoon, everybody. Welcome to the fundamental brief. Before we start having a look at FOMC later, let's have a little gander at what the markets have done for us this morning. It has been a pretty tricky one. If you look at the 5-minute chart, what we've managed to do is break outside of our initial balance. We started on a trend upwards, so we broke from 04s, we got up to 33, which was a relatively nice move higher. So once we gave ourselves the direction of the day, of course we had quite a big aggressive pullback. And that pullback pushed us very much through this initial balance high, pushed us down to a low of 97. So that is 8 ticks through our initial balance high, only to then decide that we didn't want to be back down here, so we started pushing back to the upside and obviously took out the 33s and got ourselves up to 46s. So the tone is there that we're moving upwards, and if you look at our profile, value has shifted higher quite comfortably. We've held the open, which is always a good sign, but of course when we've got a market that is moving in a certain direction and you get these big washbacks and these big pullbacks, it really does make it quite difficult. I mean, if you look at it in a sense, in terms of TPO counts, we've almost got a triple distribution day. We certainly haven't in terms of volume, but we've got a triple distribution day, but without any breakouts, without any single prints, and in effectively what is a 35 tick range. So it's very messy. I don't know what else to say other than, the sign was there the day before when we had a normal day that this was slightly peculiar. Of course, yesterday again was reasonably peculiar, where we had this open drive lower and then just on a knife edge turned. And today we had a tight IB, which is always leads you towards thinking in terms of a trend day or a P-print shape day, or a variation of a normal day. But of course we haven't had either of those turn up. We've just had this very, very strange setup. The only thing I can say, it is December, it is FOMC day, it's only got 300,000 lots. I think the rule book goes out the window on days like this, and I think as much as I try to allude to that in the streams and the morning session, I think that's pretty much what has happened today. It's just, you can't expect the market to make sense or to do certain sensible things when on 300,000 lots, presumably the majority of participants aren't trading, the majority of participants aren't interested in trading until the FOMC, and you've just got a lot of algorithms fighting each other, and they're not necessarily all programmed to trade in terms of market profile. Looking at the Eurostoxx, I mean, that just sums up a pretty quiet day, sums up what we're looking for. Yes, the open has held, but we're in a 15 tick range, very nicely balanced in that 15 tick range, but it is still a 15 tick range, so we're not looking at too much there at all. Now moving on to the 10-year before we obviously attack the Fed. Yesterday we came back a little bit lower. You can see in terms of our profile, we were thinking and we were assuming that this market should just push around this area here and balance this area off. It actually didn't happen. We ended up with what would be classed as a B-print profile. So we broke out of our initial balance and we continued to move in one pleasant direction. And this is what markets should do. Not AKA the Bund, but we had our initial balance. We break, we never got back through it. I mean, a great sell on the D print with your stop above here. Fantastic trade. That's all you could be asking for. Ended up being a B print profile. So again, you know that your target's fairly well in place when you've established those extremes, which ended up being down to the bottom end of the value area low. So at the minute we have had a little pushback higher, so we're back into this little void here at 6.5. So we've come back off the lows, dragged up by the Bund. So in terms of what we've got an overnight low at 123.31 and a half. We have an overnight high of 124.08 and a half, and we are currently trading at 07. So we've just come back into the open area where we left things yesterday. In terms of balance for this market, we're just to the south side of standard deviation, but not by a great deal, by 10 ticks or so. And of course direction is going to come from this afternoon / this evening's Fed conference. Now, what we're looking for the UK guys, it is a 7 o'clock release. We get the announcement of the rate decision, and we get a statement as well that comes from that release. So we get both come out across Reuters. Of course, it's very, very quick and fast, and you should be really listening to your squawk provider to help you here. They are the experts in monitoring the important parts of the Fed statement. So we get that statement. We get a summary of economic projections, which is short labelled as SEPs. And of course it includes the now infamous Fed dots. If you're unsure what the Fed dots are, they are a guide as to where people expect the rate path to be heading. Of course everybody does have their separate inference as to where rates will be. And I'm just wondering if I can current Fed dots will bring up a search, I'm sure. So for example, it will look a little bit like this, courtesy of Business Insider. So it will look a little bit like this. Basically it's all the members of the Fed kind of outlining where they feel the range of interest rates are going to be in terms of current sort of rates. So at the moment we're seeing sort of 2017, 2018, 2019, and then of course we get the longer run. Interestingly, the longer run has now been pushed further down, so that's the general dovishness and dovish tone that we have been seeing. So we do get the release of these Fed dots. It's a guide as to where, as I've said, every Fed member, every Fed voter sees rates going and sees the rate path towards the end of 2017. So we get all of this released. It comes out at 7 o'clock, and then we get a press conference by which we should have actually ascertained pretty much what the market is seeing and the consensus of the market. That comes out at 7:30. Now, where we're at, we are expected to see the Fed raise the target range of their rates by 25 basis points to 0.5%. to 0.75. Of course, currently they lie at 0.25 to 0.5. This is expected to be a unanimous decision. It is priced into the market that there is a 91% probability, that's the market pricing, that the Fed are going to raise rates by 25 basis points. That is what is expected. The key at this moment in time is not only their economic projections, not only their dots, but it's how the Fed decides to communicate the path, the future action that they are going to take over the next 3-4 years, especially, of course, because we have got a new president, a new fiscal set of policies likely to come in under Donald Trump's administration. Now, what has happened previously is that the Fed has always pretty much, very much like Mario Draghi, they manage this balancing act. I don't think they're as good as Mr. Draghi, but they manage this balancing act where they emphasize that it's going to be a gradual tightening. They're not looking at embarking on a very strong cycle. They need to allow time between rate rises to assess the impact of A, the rate rise, and B, also the changes that are upcoming in the fiscal policy. So that's where the intrigue lies, and that's what we're looking for. We are expecting some minor adjustments to these economic projections, looking really at upward revisions to GDP, possibly inflation, and a slight, obviously, but still bullish adjustment, but a downside adjustment to employment, so i.e. unemployment getting better. The Fed dots, now these are interesting at the moment. The way they price in and the way they look at the moment is we're expecting them to be unchanged. At the minute, it would indicate 2 hikes in 2017, which would get us along the dot curve. It would get us at the end of 2017 to a range of 1 to 1.25. That is where the majority of the Fed dots lie. So we've got 2 voters that are still down at 0.5 to 0.75. We've got 1 voter at 0.75 to 1. We've got a lot of voters, 7 of them, at 1 to 1.25. And then above there we have the hawks that are pushing us up, with 1 person expected at 2 to 2.5. So at the minute, the way those dots lie, we are looking at potentially 2 rate hikes over the course of next year, 2017. The way the dots continue to move is that the majority of forecasters see, or voters see, the range moving from that 1.1 to 1.25 to 1.75 to 2%. That indicates 3 rate hikes in 2018. So that's what we're looking at. At the minute, we're looking at a unanimous vote of 25 basis points at this meeting. We're looking at the dots to be left unchanged, giving us 2 hikes in 2017, 3 hikes in 2018. That is your key barometers. Now, aside from this, we're looking for some revisions to the economic projections, but again, these are largely priced in. And there's also the possibility that the statement may reflect the improving economy. They could potentially say that there's a firming and the outlook, the risk to the outlook has moved from roughly balanced to balanced. That would be, again, a slight hawkish tone. But of course, they could really go dovish here and emphasize that there is a new fiscal regime. There's likely to be tax cuts. There's likely to be, fiscal, spending, and that they don't know the impact of this, and therefore they, would be looking to really assess the impact of this before they move too far and too quickly on rates, because that's the last thing they want to be doing, is moving too quickly. Within the press statement, most of the move probably should be done, but you would look for Mrs. Yellen to highlight that the pace of rate hikes will be gradual, convey maybe a slight upbeat view of the economy, yet at the same time uncertainty around the future fiscal policy remains very, very high, and therefore that's why they are looking to be patient. And I think it was Kaplan who came out and said it's important to be patient and let events and policies just unfold. Do what you've got to do now, and see what happens in the future. As more clarity comes through, then possibly they will look to do something else. Now, with these Fed dots, bear in mind that if they do move, and if anyone does step up, that is going to be viewed as hawkish. So have it outlined as to where you see those Fed dots. If you see some of the baseliners at 0.5 to 0.75 shift up, or you see some of those 7 shift up as well from 1 to 1.25, if they shift up, then that is going to be a shift of the average, the median Fed dots. At the moment, they are still comfortably priced with, the median being the 2 rate hikes. If you work out basically the median being adding them all together, dividing them up by 13, it comes in at 1.1%. That's where they're expecting rates to shift. So that would mean those 2 rate hikes. If any of the dots shift higher, especially the ones that are at 1 to 1.25, the median will shift. And it means that it will imply 1 extra rate hike next year than we currently feel is on the cards. So these Fed dots are quite important. You can access them. I would have thought Bloomberg, CNBC, Reuters, any of these, news wires would very, very easily be able to put the, show you, well, they must have these Fed dots. It must be on the Fed's website, to be honest. Let's cut to the chase. It'd be on the Fed's website as to where the dots are. So if we see a shift up in any of these, that is an extra rate hike, and that is not priced in. So at the moment, consensus is dots to remain the same, implying 2 rate hikes next year, and for a 25 basis point hike. If that happens and the dots remain the same, I would expect the market reaction to be muted and not a lot go on. And we will be looking for the tone in the press conference as to how dovish lovely Mrs. Yellen is. If the dots move up and you get your rate hike, that is not priced in. You want to be looking for 10-year bonds to sell off. Bund will get dragged with it, although the Bund is traditionally a nightmare to trade that late in the day. So your 10-year will sell off. It obviously will shift the outlook. Your 5 years will sell. Your 2 years will certainly sell. So expect the markets to come off, in line with those Fed dots. I am expecting the equities to sell off as well. I think an aggressive stance on interest rates is going to make equities sell off. I think we've had the pump. I think if we get very hawkish, we will get the dump. That's my view on it. If everything remains the same as expected, I think you're going to be in for a chop fest. And if for whatever reason either the Fed dots move down because people are concerned about Mr. Trump, or they don't raise rates, you are going to see the mother of all rallies in the 10-year. You are going to see rallies in the 5 years. You are probably going to see the equities dip lower before finding their feet and come off. They may just get spooked by the fact that the Fed are so concerned about the the upcoming events, that they can't raise rates. That might be viewed as a concern. So you might see just a tiny bit of a sell-off, but eventually, the equities are addicted to low interest rates and quantitative easing, so they should recover. But certainly you'll get a little bit of that flow out from the equities back into the bonds on the basis of low interest rates, but I think it could be tricky. So actually either way, you are possibly looking at a beginning knee-jerk sell in the equity markets. I think if they are really hawkish and the bonds start having a major sell-off, then you could just see a bit of cash get put back into the equities to halt that move. In terms of the dollar, of course, more hawkish, the more strength you're going to have in the dollar, the more dovish tone comes out. Of course, you're going to get vice versa. In terms of some of the rates, just very quickly, looking at GDP, they're expecting 2017 to be 2%, 2018 2%, and 2019 1.8. That is the current no change consensus. Unemployment is expected to be 4.6 in 2017, 4.5 2018, 4.6 2019. So that's what we're looking at. I really do hope that helps. I think I've managed to get it across quite nicely. I'm going to let you go now. Obviously, the 10 years have opened. At 1:30, just bear in mind, you've got a load of data. Retail sales, PPI core, PPI final, retail sales ex autos. 2:15, you've got industrial production. You've got business inventories at 3 and the DOE at 3:30. So a very big, busy afternoon. You've got no supply, no other speakers to contend with other than the FOMC. Alright guys, well look, as I say, I really hope that helps. Anyone has any questions whatsoever, please ask me, whether you are on the trading floor in the room, or whether you are outside. Feel free to send a quick email or a tweet, will probably get seen a bit better, and I will obviously do my best to help. Alright guys, other than that, I will leave you to it. All the best. I will pop back on at 2 o'clock, but obviously there's going to be relatively little to say, but I will be here. I will pop back on. Don't forget, Thursday, Friday, there are a couple of changes. Tomorrow morning I will be streaming from home, so you'll get a slight dip in the quality, but then and there's no streams in the afternoon. Friday I'm back in the office, and of course there's a few streams there. Alright guys, take care, and as ever, please trade professionally.